You had a strategy that was working, you back-tested it, you refined it, you put real money behind it, and it delivered. You had evidence, not a feeling, actual evidence that your edge was real. And then you hit a rough patch. 3 losses in a row, then 4, then 5. And somewhere in that stretch, the evidence stopped mattering. Because the losses felt louder than the data. The questions started coming. Is my strategy still valid? Has the market changed? Am I actually reading price action the way I thought I was? Maybe this approach doesn't work anymore. Maybe I need to change something. And those questions feel completely reasonable. They sound like the kind of honest self-reflection a serious trader should be doing. But in the middle of a losing streak, when the emotional pressure is at its highest, those questions are almost never coming from a place of clarity. They're coming from doubt. And doubt, left unchecked, shows up in your trading in ways that cost you just as much as any bad strategy ever could, just more quietly. And in the exact moments when your edge was about to reassert itself. Today, we're going into what a losing streak actually does to your psychology, how doubt silently rewires your behavior at the platform, and the framework that lets you keep executing through a drawdown without abandoning the edge that will pull you out of it. A losing streak is not evidence that your strategy is broken. It is not a signal that the market has changed. It is not proof that you've lost your edge or your ability to read price action. In most cases, a losing streak is variance, the normal, statistically expected clustering of losing trades that every probabilistic system produces over time. If your strategy wins 55% of the time, it also loses 45% of the time. And losses don't distribute themselves evenly across sessions. They cluster. They come in groups. A run of 5, 6, 7 consecutive losing trades is not only possible in a 55% system, it's mathematically inevitable over a large enough sample. It's not a warning sign. It's the system behaving exactly as probability says it should. The problem is that this is almost impossible to feel in the moment. Knowing that losing streaks are expected is completely different from experiencing one in real time. Watching the account decline session after session and maintaining the conviction that the edge is still there and still real. That gap between what you know and what you feel is where doubt lives. And it's where the most expensive decisions of a losing streak gets made. Psychologically, it attacks from a direction that's completely opposite to overconfidence. But the neurological damage it does to decision-making is just as significant. During a winning streak, dopamine compounds with each win and inflates the brain's risk model, making the next trade feel more certain than it is. During a losing streak, the opposite happens. Each consecutive loss triggers a cortisol response that accumulates. Stress compounds with stress. And one of the primary effects of sustained cortisol elevation is the suppression of risk tolerance. The brain, detecting a pattern of threat, begins to treat all uncertainty as danger. This is why losing streaks can produce hesitation rather than aggression. The brain isn't pushing you toward more trades, it's pulling you away from all of them. A valid setup appears, and instead of the clean, decisive execution that your process calls for, something freezes. You wait for one more confirmation that was never part of your criteria. You reduce your size so dramatically that even a winning trade barely moves the needle. Or you watch the setup play out without you and feel simultaneous relief and regret. Relief that you didn't risk more. Regret that your system was right and you didn't trust it. There's also a well-documented cognitive pattern called the gambler's fallacy in reverse, sometimes called the hot hand fallacy's counterpart. After a streak of losses, the brain begins to overweight the likelihood of future losses, treating the recent run as predictive rather than random. The last 5 trades lost, so the next one probably will too. That belief is statistically unfounded. Each trade carries the same probability regardless of what came before. But it feels like pattern recognition. It feels like reading the situation correctly, and it quietly poisons the execution of the next valid setup before the trade is even placed. Doubt doesn't announce itself. It shows up in behaviors that each have their own justification. And that justification is what makes them so difficult to catch in real time. The first way doubt shows up is hesitation on valid entries. The setup meets every criterion. The plan says enter. But something holds back. One more candle, one more confirmation, one more piece of evidence that it's going to work. By the time that evidence arrives, the entry has passed. The trade plays out without you. And in the journal, the entry reads, "Waited for confirmation," which sounds like discipline, but it isn't. The second way doubt shows up is in reduced position sizing that has no systematic basis. Not a deliberate, rule-based adjustment, a fear-based one. The trader who normally risks 1% now risks 0.25%. Not because their framework says to adjust during drawdown, but because the recent losses have made the idea of another one feel unbearable. The problem with this is that when the winning trades eventually come, they're so small that they barely offset the properly sized losses. The math of the system has been broken from the inside. The third way doubt shows up is strategy abandonment. After enough consecutive losses, the conviction that the strategy still works starts to crack. The trader begins changing things, adding indicators, switching timeframes, avoiding the setups that have been losing and searching for something that feels different. Each change is framed as adaptation, as improvement, as necessary evolution. In reality, most of it is the doubt response. The emotional need to do something different because what you've been doing feels wrong right now. Bouncing strategy to strategy, only to repeat the cycle and never truly committing to one. And the cruel irony is that the moment the strategy changes is often the moment the original approach would have started working again. Now here's where the solution requires some honesty, because there are two distinct scenarios during a losing streak, and they require different responses. Treating them the same is one of the most common mistakes a trader can make in a drawdown. The first scenario is a losing streak within normal variance. Your strategy hasn't changed. The market hasn't shifted in a way that specifically breaks your approach. The losses are real and they sting. But when you review each trade objectively, not emotionally, they were valid setups that didn't work out. This is variance. And the correct response to variance is to keep trading. This is the hardest thing to do and the most important. Stopping during a variance-based losing streak doesn't protect you. It guarantees you miss the reversal. Because the market doesn't send a notification when the streak is about to end. There's no signal that says, the next 3 trades will be winners, now is safe to re-enter. The edge reasserts itself while you're watching from the sidelines, in the setups you passed on, in the sessions you sat out because the recent losses made the risk feel too high. Continuing to trade through a variance-based losing streak, at normal size, with the same criteria, with the same execution, is not recklessness. It is the probabilistic discipline that systematic trading requires. The traders who survive long drawdowns are not the ones who stopped and waited for conditions to feel better. They're the ones who kept executing the process while conditions felt worse, because they trusted the math over the feeling. Now, the second scenario is different. There are specific market conditions where certain strategies genuinely don't work. Not because the strategy is flawed, but because the environment it was built for isn't present. A momentum strategy in a choppy, low-volume market. A breakout approach during a period of heavy news-driven reversals. These are conditions where stepping back isn't doubt, it's intelligence. But you need proof before you make that call. Not a feeling. Not, This doesn't seem right. Actual documented evidence, either from your trading journal showing that your strategy historically underperforms in these specific conditions, or from years of experience with the approach that gives you genuine pattern recognition about when to stand aside. Without that proof, the market conditions don't suit my strategy is just doubt with a more sophisticated justification. The bar for stepping back entirely needs to be objective and high, because the emotional pressure of a losing streak will push you toward that justification far more readily than the evidence warrants. There's one tool that makes everything in this video possible, and it's the same one that's come up across this entire channel. During a losing streak, the journal serves a specific and critical function. It separates what actually happened from what you feel happened, because those two things diverge dramatically when the emotional pressure is high. When you review your losing trades in writing, setup by setup, entry by entry, with the rules laid out clearly, you can answer the question that doubt is asking. Were these valid setups that didn't work? Or were these genuinely substandard entries that deserve to lose? That distinction is everything. Because if the trades were valid, the losses are variance, and the solution is to keep going. If the trades were substandard, the losses are feedback, and the response is to tighten the criteria, not abandon the strategy. The journal also gives you the historical baseline you need to assess market conditions objectively. If you have 6 months of data and your strategy has a documented pattern of underperforming in low volatility consolidating markets, you have genuine evidence to inform a decision to step back. That's not doubt, that's data-driven risk management. The difference between the two is the record, and without the record, you're always just guessing whether the current conditions genuinely break your edge, or whether the losing streak is telling your brain a story it wants to believe. Use the journal during a losing streak not as a judge of your performance, but as an anchor to reality. The trades either met your criteria or they didn't. The data either shows a condition-specific pattern or it doesn't. Those are objective questions with objective answers. And in the middle of a losing streak, when everything feels uncertain, objective answers are the only thing you can fully trust. A losing streak and a winning streak are both tests of the same thing, whether your process holds when your emotions are pulling it in a different direction. Overconfidence pulls you toward more. Doubt pulls you toward less. Both are the feelings overriding the system. Both are expensive when they go unchecked. The answer to both is the same. Trust the process over the feeling. Not blindly, with evidence, with a journal, with a documented edge that gives you a rational basis for confidence that has nothing to do with recent results. The edge doesn't care that you're in a losing streak. The math doesn't care how it feels. The probability of the next trade hasn't changed because the last 5 didn't work. Keep executing. Review objectively. Adjust only when the data says to, not when the feeling does. And understand that the moment you stop trusting a valid process because of a rough patch is almost always the moment it would have started working again.